to Stock Shotz. Our guest today is Mr. Jerry Bowyer. Jerry is the chief economist at Benchmark Financial Network and a regular CNBC contributor. We're so pleased that he took time out of his schedule to share his thoughts on the economy with us here on Stock Shotz.
Our guest today is Jerry Bowyer. Jerry, thank you for taking time to be with us on Stock Shotz.
Pleasure to be here with you, James.
Jerry, it's been a rough couple of days for the markets, and you've argued recently that we're not going into recession. If oil prices continue to go up, will this make you change your position?
Yes. There's a point at which the oil prices are unsustainable, although I don't think we're likely to get to that point. And also, I think that the scenario of the improbable recession, for me, is different than the scenario that's been played over and over again in the media. The scenario that's been played over and over again in the media is completely focused on the consumer. And what it says is high oil prices mean high gas prices. High gas prices mean a decrease in consumer spending, and then you get a consumer spending recession. I don't see that scenario playing out because, in fact, gas prices are a component of consumer spending. So if you're spending more on gas, yes, you spend less on sweaters, but you're spending more on gas. And there are companies that distribute gasoline. There are companies that refine gasoline. So, that's still part of the American economy. I think if there's a point at which, and I'm not sure exactly where that is because we're in uncharted territory, but there's a point at which oil prices put such a squeeze on profits that you have a business-led recession. So far, we haven't had that. We still have positive profits, if slower growth than last year. So we're not there yet, but theoretically, I'm sure there's some point at which oil prices get so extreme, if they got so extreme, could cause such a squeeze in profits that we'd have a business recession. But so far, we haven't had it. For all of the over-prediction of recession for the past year, and for some longer, pundits and economists and media types saying we're already in a recession. The debate's over about whether we're in a recession or not. It's just about how long. I debated Jim Rogers a few months ago on Kudlow and Company, and he said, "Young man, you need to look at your numbers again. We've already entered a recession." This was maybe 4 months ago. Well, I've looked at my numbers again, and so is the rest of the country, and we ain't there. It hasn't happened, and I would not bet on it happening.
Well, and we've had Jim Rogers and we've also had Peter Schiff on our show recently, and they are both talking about inflation and the dollar. And Peter Schiff even makes the argument that we're not going to be able to contain inflation. Do you see the Fed having enough tools in their chest to be able to contain inflation?
Yeah, I see them having enough tools. I'm not 100% convinced that they have the guts to use all the tools. So I'm concerned about inflation. Now, the difference between me and Peter Schiff is Peter Schiff has been concerned, about the coming hyperinflation, as far as I can tell, for something like 5 years or longer, and we didn't get it. So in 2003, when the Fed was really loose, in 2004, I said we're going to get some inflation, and we did. But about a year later, we got a little spike in inflation. The Fed got very tight in 2006, and I said, well, we're going to see some deflation. And we did. We saw a credit crunch, and we saw very low prices and actually some negative months. Now that the Fed has gone very loose again, I am concerned about inflation. But I'm not concerned about inflation as though it's an inevitable problem. The Fed loosened the money supply because they saw a credit crunch problem. They saw areas in financial markets that didn't have enough money, where there was a liquidity shortage. So the Fed started to do what it usually does, which is when some part of the economy doesn't have enough money, you print more money and send it into all of the economy. At some point, they figured out that wasn't really a sufficiently honed tool, and that if you want to get money to the drought, to the money drought, then use some other tools. So they created these various auctions, which I'm sure you know about, where they use the discount window rather than the open market operations window, so they can target individual banks or individual clusters of banks. So that created a scenario where they could put the money where it's needed without flooding the whole globe with extra dollars. Now, they're still flooding the globe with extra dollars, but they don't have to. And I think one of the reasons why they only cut down to two percentage point Fed funds target rate, as opposed to going down to 1 like they did, back in 2003, is they now understand that they can put liquidity where it's needed and not flood the whole world with dollars. I think that also gives them the discretion, if they have the guts to do it, to start hiking earlier, to start to take out some of that excess liquidity without the fear of worsening or recreating the credit crunch, because they can always use the discount window to put money where it's needed.
So, given that scenario, if they if they maintain their focus, do you think we're better than 50% through the credit crunch?
Yes, I'd say considerably better than 50% through the credit crunch. I mean, look at the TED spreads and all these other risk spreads. They've been shrinking dramatically. They're not quite to the level they were before the beginning of the credit crunch, but those spreads may have actually been too safe looking. There is a certain amount of risk in the economy, so we might be getting close to the point where these various credit indicators are indicating the actual amount of risk in the world, rather than an artificially low or artificially high amount of risk.
Well, we've had several guests on the show that contend that inflation is going to be demand-driven, and as the economy slows, prices will moderate. But then we've had others, such as Mr. Roger and Mr. Schiff, that contend that this is a global demand story and that basically it's going to be out of our control domestically. Do you think that inflation is going to be demand-driven?
No, I don't think inflation is demand-driven. I think that's a problem at the theory level. That demand-driven inflation is a myth, that if the demand increases, let's say we have an increase in demand for commodities. Well, we don't have to suppose it. We do. Globally, we have a tremendous increase in demand for commodities. So we have higher commodity prices. With a fixed amount of money in the U.S. economy, more money spent on, say, a gallon of gasoline is less money spent on something else. So demand doesn't shift in aggregate. It only shifts from one product to another. So less demand more demand for one product and a higher price means less demand for other alternative products and a lower price. So the only thing that in the mid-run or long run increases inflation is money supply. Milton Friedman spent his whole life studying this and lived in the data, and he came to the conclusion that inflation is always and everywhere a monetary phenomenon. And there's this sort of Keynesian idea out there that's constantly bandied about, even though the theory has been destroyed decades ago, and the people who talk on TV or the commentators always talk about demand-driven inflation and how, the price of oil is going to work its way through the economy, or the price of whatever is going to work its way through the economy. It doesn't work that way, because if there's greater demand for one thing, there's less demand for another at a fixed level of income. So no, I don't believe in demand-driven inflation, and I've never seen it. I can't point to any place in U.S. history where we had demand-driven inflation, where we had pervasive inflation in the economy without a change in monetary policy or change in money supply.
Well, given where you see the economy right now, and I know oil is a wild card, but given where you think we are, what are your favorite sectors over the next 12 months?
Well, that's a good question. I'm not doing a 12-month horizon right now, because in the middle of that period we have an election, and that election could change everything. So we're adjusting frequently. With Benchmark, we do investment committee meetings on a monthly basis rather than quarterly to adjust frequently, and certainly this year more than others. We're really keeping an eye on the election. So there's different scenarios depending on what's happening with the electoral process.
For the rest of this great interview, visit our website, www.stockshotz.tv. That's www.stockshotz.tv. Thank you for listening.